All right, we are kicking off episode 2 of 3-Minute Macros, Ask Me Anything. Our first question comes from NeuroInvest. He says your book was a game changer, but it doesn't talk about Bitcoin. So Cullen, what are your thoughts on Bitcoin?
All right, thanks for the question, NeuroInvest. You know, at the time when my book came out in 2014, you could have bought one Bitcoin for $600, or you could have bought 30 copies of Pragmatic Capitalism for $22 each. If you'd held on to those two investments today, your Bitcoin would be worth $22,000 and your copies of Pragmatic Capitalism would be worth $22 each still. But you'd have an endless brain filled with monetary knowledge if you'd bought the books. So calculate the return on investment with that. But in all seriousness, what do I think of Bitcoin? So I like to think of Bitcoin basically as buying venture capital in a decentralized payment system. So that means that you're making an ultra risky bet in the success of a potential future payment system. So, you know, to put this in perspective right now, Bitcoin and crypto is still a very, very small ecosystem in the scope of the broader financial system. We're talking about something that's less than 1% of all of the world's financial assets. But in the long run, you have to think of it as I think an ultra risky, I like to think of it as a multi-decade style instrument. So super long duration. I actually calculate it out as like a 90-year instrument. So super, super long. But it can hedge the fiat payment system in very specific ways. And this is especially applicable to economies such as emerging market economies. So it's probably less applicable to a lot of developed world economies. I would argue especially to the United States, where the dollar is just not at a huge risk of being knocked off as the global reserve currency, because frankly, there just isn't a lot of competition at this moment. But in the long run, especially if you're in developing markets, Bitcoin operates as an especially good fiat currency hedge in the potential of a currency collapse or high inflation regimes. So I like to think of it, if you're in a developing market, as basically a form of asymmetric insurance risk, meaning that this is a super long style insurance policy that you're buying in the case of fiat currency collapse. Or you could think of it as digital gold is a common term that people use to describe Bitcoin. And I think that's perfectly applicable. But
all right, next up, we have a very timely question from Stanley. Everyone's talking about it. How realistic is it that the USA will default on the debt due to the debt ceiling debacle?
All right, fun questions about the United States government going bankrupt, even though it has a printing press and is literally the wealthiest economy that human existence has ever seen. It doesn't make any sense, does it? But the hilarious part about this debate is that the debt ceiling makes even less sense than the United States potentially going bankrupt, because the only way you ever hit the debt ceiling is if people in the current Congress pass legislation that results in us needing to fund that spending. So we agree to a certain amount of spending in excess of tax receipts. Congress approves this spending, and then Treasury has to come in after the fact and then fund the spending by selling bonds. But then Congress comes in later, and then they say, no, you can't fund this spending because we don't like this, because we're now going to hit the debt ceiling. And it's like, well, wait a minute, you already passed the legislation that results in this spending having the need to be financed in the first place. So then you're coming in after the fact and now holding the bond market hostage, threatening economic calamity based on what? It all seems like a lot of grandstanding to me. And so ultimately, that's what this has proven to be historically. But even when you think about it at its most basic level, the debt ceiling really doesn't make that much sense, because you're essentially holding yourself hostage based on something that you already approved. And so the bottom line is that I think that the odds of a substantial economic event resulting from the debt ceiling, I think it's extremely low. I think even in the situation that, let's say that we miss a payment on some interest because the Treasury doesn't technically have the funding and it's the Treasury general account. I think even in that sort of a scenario, the bond market is smart enough to know that there's no shortage of income or funding needs here that can be met by the U.S. government in the long run. So Congress, I think, can do things that will hold the process up. They can get in the way. But ultimately, I think that A, the bond market is smarter than Congress, certainly, and B, I think that there's exigent circumstances that would be enacted by either the Federal Reserve or the Treasury that would result in, I think, us being able to skirt a calamity that the default would certainly entail. So to me, I think the whole thing is sort of a charade. I think that politicians use it as a position to be able to, make a lot of noise and they make a name for themselves. But ultimately, I think that economically, and especially for the bond market, I think the bond market looks past this sort of stuff. And we're seeing that in the way that interest rates have operated. So what are the odds of this actually coming to fruition? I think extremely low. I'd be willing to bet very, very close to 0%.
Thanks, Cullen. Next up, we have Marcus. He wants to know what your view on ESG investing is.
Right. Thanks for the question, Marcus. ESG investing is environmental, social, and governance investing, and that is a strategy that's become extremely popular in the last 5 to 10 years, especially as climate change has become a bigger and bigger issue. And I think people should be more skeptical of the way that they implement this, especially on public secondary markets. So first of all, I think that the underlying thesis of a lot of this makes sense. I mean, we should try to take care of the environment and we should care about other people and we should do things that don't take advantage of especially other people in a way that a lot of capitalist entities sometimes do. But at the same time, I think that secondary markets are an especially problematic place to try to enact this. And the main reason for that is twofold. Number one, what you're doing when you apply a ESG strategy is you're necessarily making a value judgment, a subjective value judgment. And so the problem with that, for instance, is that let's take an example where we're looking at something like ExxonMobil. Well, you might look at ExxonMobil today and say that they're a big carbon creating problem for the climate. And that's true in a certain sense, but also if you're someone who's operating ExxonMobil, you're certainly forward looking. And so ExxonMobil is actually a huge investor in green energies. And so you could make the argument that ExxonMobil is potentially on the path to becoming one of the largest green energy companies in the world in the long run, because that's necessarily where their business is trying to pivot towards. And so when you look at that company, is it safe to argue, well, are they actually a big investor in the green movement? Are they an ESG company, or are they antithetical to the ESG narrative because of their carbon business? And it gets very messy. It gets very subjective, and you start getting into morality and value judgments that I don't necessarily think always make sense. But the second problem with this approach is that secondary markets, I think, are an especially bad place to enact this sort of a policy, because what you're doing when you buy stocks, for instance, on a secondary market is you're buying entities that when you buy stocks, you're not actually impacting whether or not that company has money. You're just exchanging stocks for cash on a secondary market. And so the problem with that is you necessarily get involved in stock picking, essentially. And if your stock picking ends up being based on some sort of subjective behavioral bias that results in you generating lower returns, well, in the long run, you being the supposedly more moral person, you now have less money. You've earned a lower return than other investors that didn't engage in stock picking. And so you actually end up with less money, less ability to enact change. And so I think those are the two main problems with ESG investing. And it's why I think people that want to enact change really should just probably go out and buy a big, broad index fund. Don't get involved in all the subjectivity of, the morality of all of this stuff, and buy companies that operate legal businesses within index funds. Earn the highest returns you can from those index funds. And then if you want to go out and enact change, do it on the primary market. Do it by actually making change inside of the real economy on the primary market, where you can spend your dollars, the more dollars you have, to make the world a better place.
Okay, next up we've got Dewey. He wants to know your view on devaluing the currency. Is inflation necessary?
All right, Dewey, this is a great question. I love thinking about this one because nobody has a really great answer for this. Obviously, in theory, a deflation or even a 0% rate of inflation is what everybody would prefer. But in reality, we've pretty much always had a positive rate of inflation in the long run. Or if we've had sort of low rates of inflation or deflation, you've had big booms and busts. And so the period like the late 1800s or early 1900s were characterized by big financial panics, huge booms and busts, but relatively low rates of inflation. Whereas over the course of history, we've seen a positive averaging sort of a 3% rate of inflation, which people would argue is consistent with a decline in living standards, which interestingly is not really consistent with the state of something like the United States, or when you look at global poverty rates over the last 100 years, global poverty has collapsed despite inflation increasing. And so it's a very tricky debate. And in my view, I think that there are two things that are tricky with this. So money inherently ends up being what we call an elastic thing. And it's an elastic money supply, in large part because even when you have fixed money supplies, you end up inevitably with credit markets. So even in a gold-based system, in fact, the reason why we have the sort of credit-based system that we have today is because bankers in the old days would hoard gold, and then they would basically leverage their balance sheets to sort of fractionally lend this out. And that's not exactly the system we have today, but even in today's system, you could argue that really the banking system is structured around a monetary system and a money type where banks are basically just leveraging their balance sheets, and credit is the natural extension of the way that money always grows, because there's never enough money, especially the money thing, if you're using a reserve currency style system, to actually go around. And so people necessarily end up borrowing, and credit sort of endogenously grows out of this system. And so a growing money supply is a feature of the existing monetary system, not necessarily a bug. It certainly can be a bug if the growth of the money supply is just out of control. But credit-based growth in the monetary system is not unnatural and not necessarily a bad thing. The other thing that's interesting about this is you get involved in a debate about the efficiency of government spending. And so with any monetary system, you naturally have a government that can create money that is enacting some sort of public purpose. And so the simplest example of that is that if you have an economy where the government is involved in operating a military, for instance, to protect the domestic citizens, well, you're going to get a leakage there, a leakage of inflation, because if the government spends to expand the military, they create money, and they're basically just, the workforce is dying necessarily, and they're blowing things up. That's a pretty good recipe for inflation there. So not necessarily efficient in the economic sense, but it could be argued that this is very efficient in a social sense. And so you get into this sort of subjective debate about, morality, and should we have a government at all? And is this sort of a trade-off that is necessary in having a flexible currency system where the government and ultimately its users are able to meet the needs? And is inflation just a byproduct, especially as a low rate of inflation, a byproduct of all of this stuff? And I don't think anybody has a perfect example, but so far, one thing we do know is that a low rate of inflation, something like a 0 to 2% rate of inflation, is not inconsistent with rising living standards in the long run.
Tom from Twitter has our next question. He said a 60-40 portfolio just had one of its worst years ever. Is it dead like so many people claim?
The death of 60-40, the never-ending debate in financial circles. I actually think this is a useful debate to have, because 60-40 is a wonderful portfolio in so many ways. It's diversified, it tends to be low fee, it tends to be tax efficient. But I think it's useful to start challenging some of the sort of mainstream conceptions about what the 60-40 portfolio really is and why it's useful. And the main reason for that is twofold, I think. I think the first thing that people have increasingly come to know about the 60-40 is that the underlying components are actually much more stock heavy than you would think. So for instance, Vanguard calls their 60-40 fund the balanced fund. And this fund is actually not very balanced at all, because 85% of the volatility in this portfolio comes from the 60% slice. And that's just because stocks are so much more volatile than bonds. Even in a year like last year, where the bond market falls pretty substantially for bonds, the stock market still drives the performance of 60-40, because the stock market is just so much more volatile than the bond market. So that's one important thing to keep in mind when you're investing in a 60-40 portfolio. I think the other thing is that you have a lot of what I would call homogeneous asset class risk inside of a 60-40 portfolio, where if you own just one fund, you don't really have a lot of liquidity inside of that portfolio, because the stocks and the bonds are all blended together. So even if you own something that may be short-term bonds inside of the 40 component, well, you really, for all practical purposes, on average, I always tell people you really own a 12-year instrument. There's not a lot of liquidity inside of this thing. So I think behaviorally, when you navigate a year like 2022, you encounter a lot of challenges in this portfolio because the stock market is driving a lot of the volatility, but also when the two asset classes become positively correlated, you get whacked with this liquidity problem where if you actually need to tap the portfolio for some reason, you don't have liquidity and you're forced to take a loss inside of some component of the portfolio. So I think it's useful to challenge 60-40 and, being diversified, having low fees, being relatively passive in your portfolio approach is super, super important. And 60-40 does a really nice job. Personally, I think it's nice to think a little bit outside the box. You can go outside of 60-40 and add components, whether it be as simple as a cash component or, me personally, I actually like to invert the 60-40 component to some degree so that you're actually throttling the equity market risk to some degree inside of that portfolio. But the real kicker is that I think it's okay to go outside of the norms. Your portfolio doesn't have to just be stocks and bonds in a 60-40 fashion. You can hold things like cash or even some insurance-like products that hedge some of this in the case of a year like 2022, where 60-40 creates a lot of behavioral risk that exacerbates the potential to make mistakes in the long run. So is 60-40 dead in the long run? Absolutely not, because that would mean that the stock and bond markets are dead in the long run. And there's no way I think that the stock and bond markets won't do at least okay in the very long run. But does it mean that 60-40 is the end all be all? No. And so for certain people, this type of a portfolio might be dead. But in the aggregate, the stock and bond markets are going to continue to do well for people that are patient. But
next up, we have a great question from CT. He points out that standard portfolio theory says to ride out the ups and downs. But what about an older person who's worried about exit and entry timing and market volatility?
All right. How does a more conservative, especially an older investor, navigate all the ups and downs of the financial markets? This is actually somewhat related to the 60-40 discussion, where I think that when you get a portfolio that has this, what I called homogeneous asset class risk, you have to be careful because you necessarily don't have a lot of liquidity inside of a portfolio like that. And so for someone who is older, who absolutely needs liquidity and maybe has a little more behavioral bias because they're just older and they have less time, I think it's increasingly important for that person to either have insurance-like buckets in their portfolio or cash buckets, or maybe both. Because when you blend those stocks and bonds, like I mentioned with the 60-40, you necessarily end up with a portfolio that ends up looking like a 12-year instrument on average, basically. And so if you're someone who's 80 years old, well, you maybe don't have a 12-year time horizon. And so you need to do something that reduces your duration of the portfolio. You need something that is necessarily more stable, whether that be cash or treasury bills or even short-term bonds of some sort. But you need some sort of instrument inside of that portfolio that helps you sort of smooth out the volatility of the stock and bond markets. And so what I would say is that, I've become a big advocate of this all duration approach that I often advocate for, where I wrote this paper last year where I actually calculated the duration of a specific instrument. So you can look at something like the stock market and then you can say, this is an 18-year instrument. You can look at gold and you can say, this is a 30-year instrument. You can look at the aggregate bond market and you can say, this is a 6-year instrument. You can look at a treasury bill and you can say, this is a 1-year instrument. And that gives you not certainty of returns, but it gives you greater certainty of returns relative to time. And so you can start to compartmentalize these things in very practical ways where, yeah, the bond market was down a lot last year, but over the course of a rolling 6-year period, that would be very unusual for a 6-year instrument where the underlying instruments have all rolled over and matured. And I think the same is true for the stock market. When you think of it as an 18-year style instrument, the odds of that thing losing money over an 18-year period are very low. But what is that thing going to do in the period of 18 minutes or 18 months? Nobody knows. And if you only hold that instrument, that super long duration instrument, well, you're exposing yourself to a lot of principal volatility. And so for people who are older, who just naturally have lower, risk profiles and less time, you have to sort of take care of that ability to meet your liquidity needs and especially your behavioral needs, because you just don't have the ability to ride out all of the volatility that the longer duration instruments are necessarily going to introduce into your portfolio. Thanks for watching, everyone. I hope you learned something new. I'll catch you next time.